Now, I was looking at some material here today about the Bank of England. Of course, this is the big take for the day. London Open already did open a few hours ago. Sorry. So we're going to be talking about, of course, the Bank of England and what are the expectations, and we're going to have an interesting look into the market and what are the market makers as well as the market in general expecting from it. All right. So let me open my tools and of course the economic calendar. All right. So as we can see, we didn't have much happening. All right. But we're going to have tonight at 9 p.m. The Bank of England, the Monetary Policy Committee, and of course the interest rates decision for April. And then after that, we're going to have the meeting minutes. That's very important. And at 30 minutes after the rate decision, we're going to have Governor Barley giving us a speech at 9:30. As well, 9:30, we're going to have German Bupa President Nagel giving us a speech. And then 10:15, we're going to have Guindos from Europe. Of course, there he is. And then after that, 10:30, we're going to have initial jobless claim as usual. That's a weekly data. It doesn't have much effect into the market, but it's always good to count down what is happening weekly on the USA. All right. For tomorrow, Friday, we're going to have some, big news, I would say, big data coming from the market. So let's start with the 30-year bond auction from US. All right. We're going to have, of course, the member policy, the member from the policy committee, Peel, giving us a speech at 2:15 a.m. from UK. And then at 4 p.m. in Australia, we're going to have the GDP, gross domestic product, month over month, year over year, and quarter over quarter, quarter one for UK. And then we're going to have manufacturing production and industrial production month over month for UK as well. After that, this is all at 4 p.m. And then after that, we're going to have right at the end of Friday, 11 p.m., we're going to have the FOMC member Bowman giving us a speech. I'm not too sure what is this speech about, but I'm curious. So let me have a look. Yeah, sort of about the monetary policy. So there is somewhat of importance to that. Okay, it's not so important because Bowman is not participating actively into the votes. Okay, so but he still have all the insights, if I can say that, insights through to the FMC, to the Fed. All right. Now, let's jump to one thing here. First of all right, let's have a look at the inflation for UK. Where is, there you go, here, inflation rate. Now, if you gonna watch the video where I've made with Nathan Bray today, you will go through this this part of the video where I say about the inflation, right? That it's around 3 to 4%, and it's sort of a sticky inflation. Why do I say that? Because if we look to the chart here, it's pretty noticeable that we came all the way from 8.7 in March of 2023 now to 3.2. Sorry, April. Sorry. April of 2023 to 3.2% in March now 2024. So in the whole year, all right, pretty much we somewhat decreased, of course. There was a big drop here from 8.7 to 3.2. So that's pretty much 5.5% of reduction of the inflation number. Is this good? Of course, this is fantastically good. But remember, okay, remember, let me just clear this and put into the 5 years. Look at where we were in October 2022. We were at 11.1% of inflation. So this is exactly what I say for Nathan, right? I say, Nathan, look, inflation, of course, it was nearly 12% in 2022 for UK. But we have to remember that the Bank of England wasn't doing too much back in those days. What I mean by this? Well, there wasn't too, of course, there was worry, all right? There was a lot of worry on the market, but it wasn't too much in a sense of we need to continue hiking the rates, we need to reduce our balance sheet, we need to cut the supply, we need to do some quantitative tightening, and so on. So the market, you know, the inflation was keep growing, of course, because people were still spending and inflation wasn't actually getting affected to the last consumers. That was the society, the population, as well. It wasn't get affected by the services prices, the manufacturing prices. All right, so still somewhat cheap to do manufacturing and cheap to provide services, as well as buying products from the shelves of the supermarket and getting services done for your house or whatever. That is in October 2022. Right after that, the Bank of England started to a little bit before after that. The Bank of England started to raise the rates 25 by 25. Some of them was 50 and some of them was 75, if I'm not wrong. Okay, I'm not too sure because I can't remember if they did actually rise 75 base points or not. But I would have to double check that. I can do that. But don't take this as a final answer, okay? So raising 25, sometimes 50, made the inflation came down. Of course. Why? Well, as soon as you start to raise the rates, it doesn't get a effect immediately into the economy. I don't know if you guys know that. But one rate hike, it takes sometimes 6 to 8 months to get felt into the economy. Does anyone know how to answer me this question? So why the rate doesn't get affected right at the time it gets done? So let's say it gets hiked 25 base points. Why doesn't it get affected by the society right on the second that they do this? Anyone have a clue? It's like a moving object. Yes. Can you elaborate a little bit more on that, Julian? Inertia, I guess. That is not wrong. Okay, so there are some changes. Accelerate first. Yes. Okay. So let me explain for you guys what happened here. It doesn't have much to do with inflation. Okay. There is the sort of inertia and there is the sort of decelerate, but it's a little bit different. So first we call this, oh, there we go, a detail. So higher interest rates mean higher borrowing costs. People will eventually start spending less. The demand for goods and services will then drop, which will cause inflation to fall. That is a beautiful answer. That is completely correct. And this is exactly what happens when the rates go up, right? But why doesn't the rate get affected exactly the time as it done? Well, there is a few a few becauses, let's say, a few reasons, right? But I'm gonna say here 5 of them. I have noted down already these. So the first one is the transmission lag. All right, it takes time for changes in the interest rates to be transmitted through the financial system. So the banks may not immediately adjust the lending as well as the deposit rates in response to the central bank rate changes. So we call this the transmission lag. So there is a transmission between the central bank and the commercial bank. Remembering that the central bank, if you don't know what is a central bank, I've just recorded a video this week on the YouTube channel. So you can go to ACY Securities YouTube channel, and that's going to be like the second or third video from the main page. All right, if you go on videos, you will see my face there, central banks or something like that, how the central banks manipulate forex market. You will know. All right, so go there and have a look on that. It's very a lot of knowledge. Now, so if you don't know, that the central banks are the lenders of the last resort for the commercial bank. So if a commercial bank has to fail, if it's running off of liquidity, it's a depot of liquidity, then the central bank comes in and, you know, they do some things for the commercial banks, such as increasing the balance sheet a little bit, putting some numbers in there, maybe even print money, maybe like we've done in 2023, maybe 2022, who knows, right? Anyways, so that's the first reason, because there is a little bit of a transmission between the central bank to the commercial bank, and then they say, okay, so let's say I'm the central bank here, and you guys are commercial banks. They say, guys, look, from today onwards, you will have to charge on the mortgage or on the loans this minimum rate. Okay, this is it. You think the boy can trick the quantitative tightening? I will get there in a second. Second thing is the contractual agreements. All right. See you, Jimmy. Many loans and financial contracts have fixed interest rates or variable rates that adjust only periodically. So it doesn't adjust as exactly. We have a oh, someone is joining her. It doesn't happen exactly as they do the rate. Right. So I don't know about you guys, and I don't want to ask this question, but you most probably, maybe if you are a little bit more older than 25, maybe somewhat 30, you've probably get a loan on the bank, right? You've probably got a loan on the bank to buy your property, or even to buy a car, or a personal loan, whatever. There are lots of reasons why they gave you the money, because they believe you have sufficient ways to pay you back, right? That's mainly the reason behind it. And of course, they want to make money from you. I find it funny because it's illegal for me to give you money and charge you an interest on top of that, but it's legal for the banks. So it's kind of funny. But anyways, because they're doing exactly the same thing, but well, you know, right? Anyways, so so there is a time where you will be able to choose either variable or fixed interest rates. Variable interest rates are, as they say, they are variable, and fixed, they are whatever you agreed, you're gonna have to pay for, well, until you can refinance as well. But yeah. Anyways, now the third one is the expectations and uncertainty. So economic agents, such as business and customers, may not immediately adjust their behavior in response to changes in interest rates. They may wait to see if the change is sustained, or if the economic indicators support the need for adjustment. Fourth reason, the policy implementation time. Even if a central bank changes interest rates, it may take time for those changes to be implemented and felt to the economy. Fifth and last is the long-term and the short-term impact. While short-term interest rates can influence borrowing and spending decisions in the near term, the full impact of investments, consumption, and economic activity may take longer to materialize, especially for long-term investment and major purchases. So overall, the lag in effect of interest rates changes on the economy is influenced by a combination of those institutional aspects that I've just mentioned. All right. So now, if we look to another chart, UK interest rates. Nice. So they've started to hike the rates. The first rate hike was from December 2021 to, sorry, yeah, it was in December 2021 on the day 16. That was a 0.25. After that, in February, so 2 months later, 0.5. After that, 0.75. After that, 1%, 1.25, 1.75. And then they started, and then they had to go. And now they are on the 5.25 since August of last year. So close, going, let's say, for a year of, you know, higher interest rates for longer. Now, I want to ask you, do you think that they will, with the inflation that it is, okay, let's come back for the inflation. Let's go for the 1 year. Inflation has been sticky, all right? It haven't been, it didn't go anywhere. Let's be honest here. It reduced 1% since October last year, 2023, from 4.6% to 3.2%, all right? Sort of 1.2, or 1.4, sorry, 1.4%, okay? This is sticky inflation. All right. Even though we had a 3.9% in November 2023 to 4% in December 2023 to 4% again in January this year, February 3.4, March 3.2. All right. So not going anywhere here. Still have the inflation in there affecting the market. Now I ask you, do you think, look at this, they've kept the rates unchanged since August last year, okay? August last year, we had a 6.7%, and then we had a 6.7% again, and then 4.6. Nothing has changed since this 4.6, only 1.4%. Now, they haven't cut from 10 to 6. Do you think they will cut from 4 to 3? What's your answer? Who thinks that they will cut the interest rates or maybe hike interest rates? What are your opinion on that? Okay. See you, Winton. So one thing here, I think they are more data orientated and we wait at least a quarter. That's a perfect answer, Ditya. That's correct. They are data orientated. Therefore, they need more data to collect, to have the evidence. Yeah, I do think it's a pause as well, Sweetie. So in my opinion, it's a pause with a neutral to dovish instance of the Monetary Policy Committee. Now, is the other question. More important than this, we have the quantitative tightening and the quantitative easing. Does anyone know what the Bank of England is practicing at this time? The real question is, Rosman gonna say, I want to cut? Yes, there is a good question actually, but that's what I'm saying. Do you think that the Bank of England can trick? I'm gonna ask you your question. You can trick the quantitative tightening? because we've been to a moment. I'm gonna be honest with you guys. We are into a moment that the interest rates can't change. It can't change, and they will only change. All right, they will only change the interest rates once they have inflation under control. Okay, now what I mean by inflation under control, the inflation under the band that they are that they can support. What are they? Well, simple. So come here in Bank of England inflation target. They have a 2% inflation target. Then we are at 3.2, so we have to reduce 1.2 yet. Remember that for us to reduce 1.4, it took us from October last year to March this year. The next one is previous, the consensus, we don't have the consensus yet, but the consensus of the last one came higher. So the consensus was 3.1 and the actual came in at 3.2. But now is the question, do you actually think that they will cut the rates while inflation is high? I mean, I don't buy these. All right, I don't buy these. I know there are all the analysts there, but like, what's the sense? Okay. They can reduce quantitative tightening like the Fed. Yes, they can, because they claim to be a how they say, Nathan, that they don't follow all the central banks. But anyways, so but then they are all making seem like they aren't watching the Fed. Exactly. That's exactly it. That's exactly it. But anyway, so coming back to the conversation. So we most probably want to have a hike. We most probably will have a neutral to dovish approach, and no changes on the quantitative tightening. Okay, for those who don't know what are does anyone know? Does anyone don't know what is quantitative tightening? I think I've explained these quite a lot already, right? Don't need to go over this again. Oh, okay. So we have quantitative easing and quantitative tightening. Okay, let me get the Bank of England. Oh, this one. Oh no, this one. Just come back. Monetary policy. Now, where is the inflation, interest rates, bank rate, quantitative easing, quantitative easing? There we go. There we go. So the quantitative easing is the two central banks can use to meet an inflation target. We use the UK central bank, and our job is to get the rate to inflation to our 2% target. We do that by changing interest rates to influence what happens in the economy. When we need to reduce the rate inflation, we raise interest rates. Higher interest rates mean borrowing costs more, and saving gets a higher return. Well, come on. Saving gets a higher return. Saving will get what's the rate now that they have? 5.25. 5.25. There were time that it wasn't 5.25 and inflation was 8. So basically you were losing money. Even, like if you wasn't making 8%, you were losing money. So anyways, so that leads to less spending in the economy, which brings down the rate of inflation. Well. Remember, I've always say that if people keep spending, then what happened? Inflation continues to go up. So they have to reduce even more the rates as they've done. So inflation come down. When we need to support the economy by boosting spending, we lower interest rates. That also causes inflation to go up. Quantitative easing is one of two tools we can use to change interest rates. The other is bank rate, which historically has been our most important tool. We first began using quantitative easing in March 2009 in response to the GFC. At the time, bank rate was already very low. In fact, it could be lowered any further at that point. So we need another way to lower interest rates, encourage spending in the economy, and meet our inflation target. Quantitative easing involves us buying bonds to push up the price and bring down long-term interest rates. In turn, that increases how much people spend over, which puts upward pressure on the price of goods and services. In total, we bought 895 billion pounds worth of bonds. Most of those 175,000 billion pounds were UK government bonds. The remaining 20 billion pounds were UK corporate bonds. The last time we announced an increase in the amount of quantitative easing was in November 2020. At the moment, inflation is above the 2% target, so we have raised interest rates to bring it back down again. We've been both increasing bank rate and reversing quantitative easing, a process sometimes called quantitative tightening, the QT. We are reversing quantitative easing by selling the assets we purchase. We began doing that in November 2022. We can use your bank reserve to buy bonds, and there are, there's a big explanation here. But right now they're doing quantitative tightening. So they've done quantitative easing, okay, as they say here. They've begun to do quantitative easing in 2009, and now they're doing quantitative easing 2009, and now they're doing quantitative. They increased the amount of the quantitative easing in November 2020, and now they're doing quantitative tightening in 2022. Okay, so basically everything that they bought, they have to sell it now. But it has to be very carefully done. Okay, it has to be like very aligned. Can't go too much, otherwise it generates more inflation. Okay, so this is pretty much it. Now, I don't think they will do more quantitative tightening that they are doing and either less quantitative tightening. I think that they will maintain as it is at the moment because there is a good pace, and they've been doing this pace since 2022. They haven't raised, they haven't reduced. So I think there's a lot of things yet to be done to the economy. It's actually one of the first priority, I would say, is reduce retail sales because they can't do this. Okay, they've been higher retail sales. Well, there are lower readings, but I mean in overall still sticky. All right, people continue to spend. Okay, I want you guys to understand something. When I say, oh, it's higher or it's lower, it doesn't mean the last reading. It means the whole total combined. It means that in the whole total combined is actually sticky somewhat. Because in my opinion, an inflation get down 1% in nearly 8 months, it's nothing. Okay, it's nothing. It's sticky, so it's too high. Okay. Oh, but it came lower than the last previous. Yes, it did. Who cares? The market felt that reaction like that, but this is it. Inflation is too high. Okay. Moving ahead. Now let's have a look at where is, there we go. So let's have a look on the GBPUSD. Let me just drink some water here. Just a second. Oh, so you guys understood what is quantitative easing, quantitative tightening? What I will do is I will share this link as well, and you can have a read and study this. All right. Listen, free content directly from the Bank of England. What else do you want? Like, this is good thing. All right. All right. So everyone good with that? Oh, good. Can we move ahead? Okay. Any questions? Just send in the chat, and then we'll definitely have a look on that. Now let's go for GBP USD. Okay. Let me do a comprehensive analysis here, and what do I think we can expect? One thing is, if we go to the ING Euro GBP, maybe 4 reasons why Euro GBP won't reach parity. No, that's not what I want. Forecast ING think maybe is this one. Let me have a look. Yeah, 25 of April. Accept. So if we look at the growth, no. April 11. We are in May right now, right? Yeah, that's not the one I want. Markets, Forex. Where is this? I won't be able to find now. But anyway, so let's go back here to GBPUSD. But remember, we have a Bank of England today. Of course, we were affected, the GBP. But we need to understand what is weaker. Okay. So if we want to trade such as those news, we need to certainly understand one thing. And this is what is weak and what's strong. What I mean by this is pretty much if you want to trade GBP, you can. That's 100% not a problem. But against what? Or for instance, it could be any other currency. So we have GBPUSD, we have GBP yen, we have Euro pound, we have pound New Zealand, so pound Kiwi, pound Aussie, right? Pound Australian dollar, GBP Aussie dollar. So you have a mixture of everything. So if you want to trade GBP on the short side, you still have to find something that is stronger than this, than the pound. And what is stronger than the pound at the moment? Well, let's have a look. Let me see if I've been logged out. Let me log in here just a second because I haven't used it for a few minutes. So they log out my session. Okay, logged in. Now, if we come back, if we go here to currency strength, okay. So right now, let me put these to 5 days. So in 5 days, we have the US dollar as the strongest currency. All right, we can see here US dollar is at 12.97. The weakest currency is the yen. The second stronger currency is the CAD, Canadian dollar. Okay, and the third stronger currency is the Aussie dollar. And then the first weaker currency is the yen. Second weakest currency is the pound. Well, pound battling with the euro for the third place right there. And then we have the New Zealand dollar. All right. So at this moment, GBPUSD seems to be the best to trade on the short. See you, mate. Seems to be the best to trade on the short side. Okay. But remember, we may have a stronger one that is the CAD. So let's have a look on GBP CAD. Okay, GBP CAD. GBP CAD would sound good for a short, looking at the currency strength. Just looking at the currency strength, nothing else. What else? GBP Aussie dollar would be a good short as well. Looking at currency strength. As I say, best entry point. Okay. So we have 3 currencies to work on: GBP dollar, GBP Aussie dollar, and GBP CAD. So let's start with the GBP dollar. Okay. Let me take this off because I was looking to something here. Now let me do this on the 1 hour. See. Okay. We have the first target very close here. and then the second target at here. Okay, and then the 0.25, the 125 looks like a good resistance. So if we do, where is this? Maybe here. This one looks good. And then we have a resistance right there. Okay, so very small technical analysis, but this is pretty much it. We don't need more than this. It's looking good. Okay, it's looking good. I can tell you this. Now we can put this down here, and that would be my trade on the GBPUSD. Because I know I'm expecting GBPUSD to be weaker. Therefore, I would wait for the market to trigger my orders somewhere between there. My take profit would be here, and my stop loss would go at the 2. So I'm risking 1 to 2% right there. Okay, so it looks good. It's okay. Now let's have a look at GBP Aussie dollar. GBP Aussie dollar is still kind of dangerous here, but let's have a look at the side if it loads. Oh, wow. Okay. Okay, okay. All right. Yeah, not looking too good here. Looking technically here, not looking too good. The target, the longest target would be down here, and I'm not looking to trade this huge. So let's go for GBP CAD. So it's good for you to have different views, okay? That's the thing. Oh, okay. There is something interesting here. There is something interesting here. So the first target I would have is somewhat between here, okay? And it's looking great. It's looking great. It's not looking bad. For the 1 hour, I would like to trade this as it is. This is not bad. This is not a bad level here. There is a support somewhat between here. So we've had a up move, and then we didn't broke yet. So we are still trading from the bottom to the top. So this is a top, this is a bottom. So okay, still trading on this range. The 60% is right at here. It tried to break again here, but it couldn't. Buyers gave up, let's say this. So the market is tending to go down. All right, my first target, as I said, would be on 170. But the entry here is the one that it's causing the problem. I don't have much to do. Let's say 15 minutes. Even 15 minutes, I don't have much. 15 minutes trend is most probably yeah, not looking great as well. Okay, yeah, look, entry wise is just the thing that I would like to, maybe I would enter at the news. This is just my personal take for this GBP CAD trade on the short. And target for a long-term trade then on the 170, 138. Not too long, but like what, maybe a week or two. And the GBPUSD I would enter if it gets there before the news on this area here. Okay, so let's have a look on GBP NZD, Julian. Yeah, GBP NZD. Yeah, look, there's a target here, but too short for too much risk. I'm not even gonna, not looking great on my opinion here. So it's too much of a ranging here down. Nah. not good in my, in mind, but my first target would be here. But see, it's too less for too much risk, even especially on GBP and ZD. Look, it's very dangerous. My best bet is GBPUSD. Yeah, but I'm looking great on GBP CAD as well. Like, I really like this setup here, because there is a nice take profit. Now let's have a look on the GBP USD on here. So GBP USD. So GBPUSD, the majority of the traders are long. So therefore, we're looking to trade on the short side. Okay. We don't want to follow the big grain here. We want to follow this small red. I want to follow, especially if we look here, right? This is a 4-hour. Every dot here is 4-hour. So if we look at the day 7 at 8 p.m. 7 at 8 p.m. 7, 8 p.m. So right here we had a switch from the long to the short, so we could enter here. That was the first position. That was a short trade here. This is one of the indicators I use. All right. Position wise, open interest is still rising. Let's see if we have any patterns. We don't. Seasonality wise, yeah, seasonality wise, it's very bearish. Therefore, until 123, but there is more on here. 124 124 on GBPUSD could be a nice target. What's going on here? 124. So 124. Could be the first target. Okay, I take that. Look, this is not a bad trade, guys. Not a bad trade. Okay, GBPUSD looking great. Now let's have a look on GBP CAD. 1.4. Seasonality wise, oh, that's much better. Still 1.4. Patterns, no patterns. DXM. Yeah, this is not looking great. Commitments of trader. Just wait for load. Takes a while. GBP wise, yeah, institutions are somewhat bland. But look, they had a switch this week. So they went from 2.8 to negative 1.2. That means that if they short it, they may know something that we don't. So that's the leverage fund. So that's the markets that actually, the people that are on the market that actually make money. But the CAD is not looking great. It's negative 23. So two negative currencies doesn't match too much. But yeah, after refining, I would stick with GBPUSD. All right, that would be my best bet as well, as Aditya says. All right, guys. So this is it for today. Do you guys have any questions? Euro dollar targets, I'm looking at 105. That's my personal take. Any more questions? One. Thanks, Julian. Thanks, mate. Aussie dollar. I can have a look on Aussie dollar. I've mentioned that on Tuesday already. Aussie dollar is still short. That was my 0.67 there. Okay. I haven't prepared much for Aussie dollar. I've more prepared for the GBP USD, GBP CAD, GBP NZD, and GBP USD. All right, guys, thank you so much. I hope everyone liked it. Don't forget to share the videos of the YouTube with your friends, so then they can have good knowledge as well. And if you have any questions, please send me into the Telegram. And I chat with you into next Tuesday. And have a great weekend ahead. All right, guys, catch up and see you. Bye-bye.